Hello, and welcome back to the next session of Get to Know Hedge Fund Investing with Carl, the Carl Investment Platform. I'm Jamie Eppenberg, and today we're talking about how we complete due diligence on our hedge funds that are on the platform, and what that means to you as an investor. So the last session we ended talking about how every Carl investment is uncorrelated to common indexes. And this is important for, otherwise there's no reason to invest in a hedge fund, right? You could just go invest in regular markets, standard common markets. So when we complete due diligence, there's more to it than even just that. While we will tell you, we have reviewed over 400 hedge funds in about 2 years. And only about a dozen or so have made our initial bar of quality. And so, our CEO has been investing for many years, and he's run a hedge fund before. He has a lot of information on what you should expect from your hedge fund and what's important. And we'll tell you that a lot of them are simply correlated to the market. So that's, it really does chop off a lot. Now, we did make an initial bar of quality for what we would put on the platform very high. I mean, we are a new firm, and this is a new concept, and we wanted to make sure we were choosing as strong statistically funds that we could. And so the way we complete this is that there is a strategy review on the funds, meaning these are all quantitative hedge funds right now, which means there's systems and algorithms. They're really removing the human emotional factor from investing and using a lot of data, big data, coming into the systems to make better investment decisions. And so there's a lot of review about how they do that. What technology are they using? What innovation do they use? And a lot of focus from us on their research and development. How do they manage the fund moving forward into interesting and new markets, right? Not just the historical markets, but how do they react as the market changes? That was actually very important as COVID came on the scene. That gave us new market conditions that really no one had ever seen in most of our lifetimes. So a lot of focus on innovation, research and development, how these funds are managing their technology, how up to date is the technology. And then there's also the operational due diligence. And I mentioned that we do this in coordination with Aon. There are firms that have expertise in operational due diligence. And in general, if you want an institutional level of due diligence, you partner with one of those firms where this is their core competency. So we also have that, and they've gone through a very robust due diligence process from that perspective. So all the funds have gone through this, and they will have completed what's considered institutional level due diligence. They also all target 15% or more in returns. So the fees on our funds, at least the 5 that are on the platform today, are 2% management fees, annual management fees, and a 20% performance fee that is only realized if the fund is performing above 5% annually. So if a fund is not performing at that level, you will not see, at a 5% level, you will not see the performance fee coming out, because they need to have that level of performance. The 15% is important for a hedge fund because there are these fees with hedge funds, and they're not teeny, but these are traditional fees. The funds have to be performing at relatively high levels, relatively consistently. It won't always be that way, but relatively consistently for the investments to make sense. Now, in the next session, I'll talk to you about different types of investors, and some of them are not as sensitive to those target gains, but and we'll explain why that is. So you'll see some that'll be a little under, but for the most part, that's important for the funds on our platform. So we have a high level of due diligence. They have to be targeting 15% or more in returns. And then we have a very part of the due diligence, and as much as we look at the 15% returns, we also are looking at the risk profiles and mitigations within the systems and within the strategies of these funds. They all have to have very strong risk profiles and risk management strategies in order to make the current bar of quality on the Carl platform. And you'll see that in the risk profiles. I believe every fund we have on today, the risk profile overall would beat the standard indexes. So we don't really have a fund with really high risk, coupled by really high returns. It's generally you're going to get high returns, but the risk profile is still going to be less than the index. That may change. So we're always looking for funds for different types of investors. And we know there are investors who will take on a lot of risk to get that higher gain. But as of yet, we haven't found a fund that we like that can meet a bar of quality even under those conditions. So we'll see what comes out in the year as we add on new funds. So I don't want to take any more of your time today. This is in general how we look at our funds. And in the future, you may see more information about the due diligence on the funds and funds that are more up and coming. So we have a bar of quality. We wanted to give you in the start all funds that were above that, but we have some really strong funds that are working their way towards that institutional level due diligence. And because they have nice returns, they're looking very good, we would want to offer those to you as well. So hopefully we can give you more information about the funds as we add and get up to that 20 and 30 fund range. All right, thank you so much for your time today in this session, and we will see you next time.